Welcome to the latest episode of Quest for Twice. It has been 2 months since I did my last episode because of the summer vacation and the kids are at home. Now I'm excited to do this new episode because of the earnings season and there are a lot of updates. So let's dive into it. Aqua reported the outstanding quarter. Its EBITDA margin increased to 40% from 39% in the last quarter in the electric segment because of the persistent high market demand exceeding the current industrial supply capacity. So in the 9 months so far in this year, ADCO generated the $320 million of cash from operations and $600 million of EBITDA. So those are the outstanding numbers. And it spent $34 million on capital expenditure and $43 million for mergers and acquisitions, and reduced the debt by $25 million and spent $110 million to buy back stock. Because of the pandemic impact, so the year-on-year comparison of the quarterly performance is not very meaningful. For example, if we look at the revenue increase year-on-year, overall it increased over 122%, and the EBITDA, quarterly EBITDA increased by 300% in the latest quarter. So those are just too big to be meaningful. So it's actually more meaningful to look at the sequential business performance in terms of revenue. So we can see that in the electrical segment, in the last 4 quarters, APCO increased its revenue each quarter. And even more impressively, APCO increased its EBITDA margin as well in each quarter, and by significant amount from 26% in the Q4 of last fiscal year to the latest quarter of 40%. So those are very large margin increase, and multiplied with a large increase in revenue, its EBITDA basically exploded to the upside. Even its mechanical segment, which has not been doing great, actually had a significant revenue increase from $114 million in Q4 last fiscal year to $193 in the latest quarter. And its EBITDA margin has stabilized. The margin reduction from last Q4 to the latest quarter was due to the material inflation, which I believe is transitory and will recover. So as a result, ADCO is delivering outstanding business performance in each quarter sequentially, and that's reflected in its outlook for this fiscal year. So at the end of last fiscal year, its outlook for this year is a $350 million EBITDA, and that was raised to $450 million 1 quarter later. Then it just keep on going up to $700 million in Q2 guidance, and now the latest guidance for the full year is about 860 or $870 million. So that's a significant increase comparing to the initial guidance given at the end of last fiscal year. So this is due to the, I would say, short-term imbalance between supply and demand due to the red-hot housing market. But encouragingly, ADCO also increased its outlook for next fiscal year, that's fiscal year 2022. So initially the guidance was $400 million given at the end of Q1. Then now it becomes $400 to $450 million given at the latest quarterly earning update. So as a result, basically ADCO sees that the current imbalance in the supply and demand will persist into at least the first half of 2022. It's just a reminder that ADCO's fiscal year ends on September 30th of each calendar year. So because of such outstanding business performance, so if we look at the valuation metric of enterprise value over EBITDA using fiscal year 2022, it stands at about 8 versus 14 for its industrial peers. So one can argue that this EBITDA for next year is abnormal, considering that its historical EBITDA is from $274 million in 2018 to $331 million in 2020. I don't disagree with that. I think it's going to normalize. The question is normalize to what number? This is really unknowable at this point because it depends on the housing market in 2022 as well as the infrastructure demand in next year and the next several years. So there are a lot of variables, but I would say that with the EV over EBITDA ratio at 8, there is plenty of conservatism built in. So ADCO is still a good stock to buy at $86 per share. Actually, recently, when its price retreated to $68, I bought a little bit more for a different account I'm managing. Ingredient also reported its latest quarterly earning. Before we go into the details, let's have a reminder of the overall story. So investing in Ingredient is really about investing in its stealth growth. Its growth comes from its specialty ingredients segment. So in 2015, that segment is about 25% of its overall sales. And the Ingredient is targeting to raise it to 35% each in 2023. So last year, its mix stands at 32%. Why is that important? It's because in its specialty ingredient business has a much higher margin. So as a result, even if its like core segment is relatively flat, with the relatively significant increase in its specialty ingredients business, it will still grow its earning quite noticeably. And as a shareholder, we can enjoy the earning growth and hopefully the share price growth. So with that context, let's look at its latest earning result. Before we go into the numbers, we need to discuss the overall context. So corn is a key input material for ingredient. So the top right graph shows the corn price history since 2016 to 2021. So we see that in the last 18 months, the price had a significant inflation. The impact of that inflation is that it will depress ingredients gross profit margin temporarily. But the margin will recover over time because at the end of the year of each calendar year, ingredient will be able to renegotiate its price with its customers and pass on the higher cost to its customers by raising prices. Another impact of a high corn price is that will increase its working capital. So with that context, let's look at the quarterly numbers. And it's also interesting to look at the numbers sequentially. Let's look at the revenue first. So the latest two quarters had a fairly high revenue compared to the historical numbers. As a result, the 2021 revenue outlook is over $6.6 billion. That's significantly higher than the revenues in 2020 and even 2019 pre-pandemic. However, here the gross margin matters. If we look at the gross margins, and the latest quarterly gross margin is less than 21%, and that's a relatively low, and it's almost as low as during the pandemic in the first half of last year. So as a result, its outlook for the adjusted operations income in 2021 will roughly match the 2019 level. And if we look at the adjusted earning in the first half of this year, they add up to about $410 million. That implies that the operating income in the second half of this year will be less than $300 million. That's significantly less than the first half, and that's going to be caused by the corn price inflation and the gross margin depression. An encouraging sign is that its specialty growth story is on track. As a reminder, its 2019 specialty ingredients is 30% of its overall sales, and in 2020 that grew to 32%, and in the latest quarter it grew to 33%. So that growth story is still on track. If we look at the cash from continuous operations, its outlook for this year is about $550 million, and that's significantly less than 2020 and 2019. And why? As I mentioned earlier, there is a significant impact on the working capital due to the corn price inflation. So in 2019, that impact was a $53 million reduction. And as a result, if we add that 53 back to $680 million, we get about $730 million. And in 2020, it was helped by release of working capital of $107 million. So if we subtract that from $829 million, we get $722 million. That's similar as 2019. And this year, the impact so far in the first half of this year is $220 million. So if we add that back, we get at least $720 million of adjusted cash flow from operations. And that's similar as last 2 years. And can actually be even higher if we use the high upper limit of the CFFO outlook. So I would say that the ingredients underlying business is on track, and there isn't really much to worry about. Kinder Morgan and the Energy Transfer also reported its Q2 earnings, and over there, really there isn't much to talk about because both companies have performed kind of on the same trajectory as Q1. The main differences are continuous debt reduction for both companies, which I highlighted in red. And also, Kinder Morgan committed $1.2 billion to buy Stagecoach Gas Company. It's another midstream company. So it raised its capex plan to $2 billion from $0.8 billion guidance given at the end of Q1. Other than that, everything is on track, and there is really no change to the investment thesis. I would say with the current price of about $9.2 per unit for Energy Transfer, it's still significantly undervalued if we look at its the distributable cash flow over its market cap. Emerson also reported its earnings. I don't have a large position in Emerson. However, it's important to keep track of Emerson because Emerson is supporting so many different industries. So it gives a very good insight on where things are going. For example, let's look at the trailing 3-month orders compared to 1 year ago. So this graph shows that the ratio since October 2015. So what we see that the light blue line is it's a business in the commercial and residential solutions, and it had like a huge uptick since summer of 2020. That's consistent with the red hot housing market. And although it had a declined slightly in June and from May of this year, it's still at a very high number, and that's kind of reflecting the current state of the housing market. It may not be burning hot, but it's still very hot, and that likely will continue for some time. Its automation solutions picked up significantly in June compared to last several months. That reflects the increasing confidence of its customers in various industries to increase spending, and that shows the sign that the reflation and also the economic expansion will continue. This graph shows Emerson's underlying sales growth outlook since Q1 of 2018. So 2018 had a 8% revenue increase compared to 2017, and 2019 had a smaller sales growth, and 2020 of course suffered a sales decline. And its outlook for 2021 is about 5 to 6% sales increase compared to 2020. Interestingly, if we look at the absolute numbers, now Emerson forecasts it'll have a $18.4 billion of revenue in this fiscal year. That's almost the same as 2019. So its revenue is going to recover to the pre-pandemic level in this year. And with that context, let's look at the growth story. So as I just mentioned, now it's sales in this year will recover to the 2019 number that's shown in the three columns on the left. However, because of the downturn, and also its earlier cost reduction efforts, so its EBITDA margin actually will be at a fairly high level at 23% compared to 21.5% in 2019. So with the similar amount of revenue, its profit will be higher. So that's reflected in the forecast of adjusted earning per share. Now stands at $4.07 compared to $3.69 in 2019. And its operating cash flow is forecasted to come in at $3.6 billion, 20% higher than 2019. So its growth story is on track, and Amazon has a goal of adjusted earning per share reach almost $5 in 2023, and its EBITDA margin reach about 24% in 2023. So it's well on track to reach that. The FAANG stocks also reported their latest earnings, so I updated this table. I'm not going into the details because there are many changes. I just point out that I continue to see Apple and Netflix as overvalued, given that their price to gross earning are fairly high, which stand at 17 and 20, but they only have narrow modes comparing to the other stocks like Facebook, Amazon, Google. I would say their valuation levels are more reasonable and their modes are wider. Now, let's take a look at Amazon because I do have some investment in Amazon. Amazon continued to deliver higher quarterly sales. Its latest quarterly sales was up by about 36% compared to 1 year ago, and it increased its quarterly revenue each quarter in the last number of years. So it's continued its momentum. Probably it's more interesting to look at its segment sales to gain insight of its business. So this table shows its quarterly sales since Q4 2018 for each segment. I used the purple frames to outline the trends. So its online store sales declined to 13% from 1 year ago, and that's kind of back to normal comparing to the previous 4 quarters during the pandemic. Its physical stores sales increased 10% compared to the sales reduction during the pandemic. And its third-party sales increased 34%. That's also back to historical trend and less than what it experienced during the pandemic. Its subscription service came in at 28% sales increase. That's a little less than its historical trend. However, it's Amazon Web Services and others, which is mostly advertisement, continued the very significant sales increase, and there is no sign of a slowdown, even we are coming out of the pandemic. Because the bottom three segments, the subscription services, AWS, and advertisements, have high margins. I would say the Amazon's growth story is intact, and I feel comfortable buying more Amazon stock if there is a noticeable price pullback. So that's all for this episode of Quest for Twice. Until next time, happy investing.